Happy to have you all joining today for our end of summer market update and income spotlight. Thanks for taking some time out of your Fridays. And as I said, for those who are joining from East Coast, we can let you out before happy hour, hopefully. So we actually scheduled this webinar quite some time ago, and it's good to provide a periodic market update and really balance out some of the fun events that Tortuga tends to host, right? So it's not all academic. I just wanted to provide a few opening remarks. And essentially, it's been an interesting summer, right? We've had some pretty historical events. We had the near assassination of former President Trump. We've had the fall in the Japanese stock market, at least a temporary one. We've been watching what would happen with interest rates. And as we speak, Chair Powell's, at least earlier today, been making remarks in Jackson Hole, and we have another meeting coming up next month. So it's been an interesting time. I would say even more opportune to step back and provide some color on macroeconomy and the markets. And so very excited to have some folks from Capital Group. Capital Group is a trusted partner of Tortuga. It's really a storied firm that's been around for a long time and really LA-based firm. More specifically, we have Tim Way, who's a regional vice president with Capital Group. And Tim's really our go-to guy and helps us navigate the various resources available and really find the particular expertise or product that we're looking for. Today's not about any particular product, by the way. So getting back to that expertise side of things, Sejal, though she can speak to a number of things and will a bit today, she's an example of expertise, and her particular expertise is on the fixed income side. And let me turn it over to Sejal.
Good morning, good afternoon, everyone. It is a pleasure to be here. There is so much to think about and talk about as it relates to fixed income. The last couple of years have certainly been exciting being a fixed income specialist here at Capital Group. What I'll share with you is that over the past couple of years, it's certainly been incredibly volatile, both in the equity, but more so in the fixed income markets, where we've experienced an environment where bonds really haven't served the role that we're traditionally accustomed to. And I will say that this year is also no different from the past few, in the sense that this is an asset class that is largely driven by the macroeconomic conditions. So with that said, given the impact of the macroeconomic environment that we're in, allow me to share with you some of Capital Group's views on the topics that we believe will continue to be most impactful. Things like inflation, Fed policy, the overall health of the U.S. economy, and the path of interest rates. Once we get through those topics, we'll also share some high-level views on where we see the best opportunities in fixed income today. So starting off with the first macroeconomic topic, which is inflation. Last week, we were fortunate to get new data, new information in terms of the success of the Fed raising interest rates in order to combat inflation. What we learned is that headline CPI for July came right in line with what the consensus expectations were. It came in with a 0.2% month-over-month rise. Put that into context, right now we're at 2.9% year-over-year. And this is really remarkable because this is the lowest reading that we have seen since March of 2021. Now, when we take out food and we take out energy, and we land on what we call core CPI, core inflation, we also came in line with expectations at 3.2% year-over-year. And just to, again, illustrate how we've been inching down just a little bit, the month prior, we were at 3.3. So again, we're headed in the right direction. One category that we pay very close attention to here at Capital Group is shelter inflation. The reason is because shelter inflation accounts for 40% of the overall CPI basket. And what we saw was that shelter prices ended up moving up 0.4% month over month after a slower rise in the June report. Now, shelter tends to be a little sticky. What we anticipate is that as we continue through the rest of this calendar year, it too will continue to come down. Overall, last week's inflation report has been consistent with a disinflationary narrative, and it seems to offer little to no change expectations in terms of what the Fed will do next, which I'll get into in just a moment. So if we go to the next slide, I just want to provide a visual illustration of where we sit in terms of inflation. As you can see on the right side of this page, inflation is falling. It did stall a little bit. Of course, the numbers I just shared illustrated that we are now continuing on a path toward the ultimate goal. So I'm going to get to the right side of this page in a moment in terms of what the Fed is expecting to do next. But before we go there, the other element of the Fed's framework, aside from inflation being a very important topic, is of course the labor market. And last week's inflation report came after the non-farm payroll report on August 2nd, when we received a weaker payrolls print. The market was expecting 175,000 jobs to be added the month prior, and it only came in at 114,000 jobs. The reason that this data was so remarkable for many, I would say, is because it pushed up the unemployment rate to 4.25%. And this really caused the markets to start worrying about the growth trajectory here in the United States. Since the first Friday of this month, when we got that non-farm payrolls report, last week revealed that we also got the Bureau of Labor Statistics preliminary annual payrolls benchmark revision. That's a bit of a mouthful. Basically, what it said is that for the 12 months that ended in March of 2024, the revisions came in at a negative 818,000 total jobs. So if the revisions were to be spread evenly over the course of the year, this implies that the average monthly gain in payrolls between March of 2023 and March of 2024, again, evenly spread, was 174,000 jobs per month. Now, the reason I bring up this data point is that the labor market is showing signs of slowing down a little bit. We're not in any sort of dire circumstance, but we're seeing that the labor market is starting to weaken a little bit, which of course is expected given the aggressive tightening cycle and the increase in interest rates over the past 20 months or so. Other data points that just reflects the overall health of the economy that have come out in the last couple days are things also like retail sales. The recession concerns that were really elevated after the jobs report on August 2nd were eased last week by the retail sales in July, which was, this week, which was stronger than expected. So the stronger retail sales indicated that the consumer is still resilient despite a softening labor market, right? So again, when we put on our Fed cap and we think about what the Fed is considering, on the one hand, they're trying to make sure that inflation gets under control, but on the other hand, they're also trying to make sure that the labor market doesn't completely unravel in this particular environment. Now, two other things that I want to touch on. We already talked about inflation, economic health, labor market, is that this week we also got the minutes from the July Fed meeting, which offered really few surprises. It was largely reaffirming that inflation is moving in the right direction, but at the same time, the minutes acknowledged that there are elevated risks around the employment situation. The release also noted that several officials saw a case for a 25 basis point cut at the July meeting, which obviously did not happen. But the vast majority of the committee members believe that September is the appropriate and expected start for that first rate cut. Participants also view that the incoming data that we've started to see is boosting confidence that inflation is moving toward the 2% target, which obviously it is. And what we're going to be looking for next is going to be the PCE report, the Personal Consumption Expenditure Report, which is going to come out next week. Now, the reason PCE is even more important than CPI is because that's the number. Core PCE is the number the Fed is trying to get to 2%, right? And right now it's staying below 3%. So again, in the right direction, a stone's throw away. We'll see where we land next week when the new report comes out. What also came about in this week's Fed minutes you can tell I've been on vacation for the past couple of days, so I'm thinking today is Monday, is that the majority of the committee members also flagged risks to the employment side of the equation. Now, I know I'm sort of repeating myself, but it's important to note that the market recognizes the labor market softening, Powell is recognizing it, other committee members are commenting on it. So the outlook for economic growth in the second half of 2024, based on the last Fed meeting, was also marked down. And the minutes noted that easing too late, if they wait too long, could unduly weaken the economy. So not only are they trying to make sure inflation comes down, but they're also wanting to make sure that they don't stay higher for longer too long, because if that's the case, they can cause some unnecessary strain in the economy. Now, the final point I'll make, just as we recap the entire macroeconomic landscape, is what Jeff alluded to in his opening remarks. This morning, we heard from Chairman Powell. He delivered his commentary at the Jackson Hole Symposium, which is an annual event that takes place in August. His speech was this morning at 7 a.m. And again, similar to what I've been saying now repeatedly, he did in fact flag a cooling labor market and argued, quote, he says, quote, "The time has come for policy to adjust," end quote. So again, we're always listening to semantics, we're listening for context clues, we're listening for new information that can give us a little bit more understanding of what their path is next. And based on this morning's remarks, it sounds like September is certainly on the table for that first rate cut. Initial analyst takeaways, so aside from just Capital Group kind of general market consensus views, was that this morning's commentary had a dovish tilt, and his speech largely met the market's hopes for an explicit signal for rate cuts this fall. He also remarked, again, reaffirming everything that I've just stated, his confidence in inflation being on a sustainable path toward that 2% target. And he thinks that there is evidence that the economy will get back to the 2% target while maintaining a strong labor market. So he's still holding on to this belief that they can achieve a soft landing, bringing inflation down, not ruining the economy or pushing us into a recession. Again, similar to the minutes that we heard, today's release was largely focused on elevated risks around the labor market. And then again, just saying that it's unmistakably cooled considerably. So again, just really acknowledging that, hey, we're not turning a blind eye to the fact that it is harder to get jobs and the participation rate has moved up. One other comment that I'll just share anecdotally is that at Capital Group, we bring in a lot of external speakers to kind of share their views and opinions. And recently, about 6 weeks ago, one of our portfolio managers, the fixed income team, Richie Twazon, had the opportunity to have dinner with a former Chicago Fed president, Charles Evans. He was actually in that role from 2007 to 2023. Evans was. Richie's still in his seat. And what he shared with Richie was that one cut would be embarrassing. They're not going to cut just once unless they plan on cutting at the very least 2 or 3 times. Okay? So hearing it not necessarily from the horse's mouth, but someone who had been on the committee for 15 years, what we heard from that is while we are so focused on this first rate cut, we have to remember it's not going to be a one and done scenario. And there's going to be continued opportunity for fixed income looking forward and out the windshield rather than looking through our rear view mirror. So with that, let me pause for a moment. I've just shared a lot of information on terms of our views around the macroeconomics. Let me turn it back to Jeff just to check in, see if there's any other questions before we switch gears. And actually, I think I'm turning it over to Tim to talk about equities, and then we'll get back to opportunities in fixed income.
And Sejal, while you do mention it, that is a good reminder. We have the chat disabled, but we have Q&A open. So if anyone has a burning question, feel free to send it through and we'll try to address it sometime during the webinar.
Thank you, Sejal. Thank you, Jeff, so much. And thank you everyone for taking the time today. Because Sejal ended with an anecdote, I will start with an anecdote as well too. Both Jeff and Sejal mentioned that Chair Powell is speaking at Jackson Hole today. Next week, for the first time, I'm actually taking a personal vacation at Jackson Hole, and my hope is that at some point I'm going to bump into Jerome Powell or any of the Fed officials going fly fishing, but there's a high chance that it won't be. So unfortunately, I didn't get the main invite to the symposium, but I'm going to be there next week.
Is that,
So
is that
today we'll
how
talk
Capital
about,
Group, that's how Capital Group does its research? Try to
no,
bump into folks fly fishing?
yeah, that's the secret plan, exactly. So Sejal talked about the macroeconomic landscape. I'm going to dive a little bit deeper into the stock portion, the equities, and similar to the title of this webinar, right? We've called it the Income Spotlight. So that's what I'm going to focus on primarily. And just to level set and a bit of a primer, if you look at a stock, there's multiple levers that drive its total return. So let's say a stock will return 8 to 10%, of which the main portion is going to be something called the earnings growth, right? This is how much the company revenue is growing. That could be somewhere between 5 to 7%. You also have another sliver, which is multiples expansion, which I won't get into. But the last portion is an area called dividends. And think about this as a bit of an annual or quarterly bonus. So we want that dividend, right, depending on the strategy, to be somewhere around the 2 to 3%. That's going to be the focus for today, because from our standpoint, it tends to be one of the more underappreciated opportunities that we see in the market right now. So I'm going to walk through, maybe 2 or 3 concepts and slides. But just starting here within the United States, there's a lot of what we would now call short-term narrow optimism, right? And the key word there is narrow. So for context, as of today, the S&P 500, right, which is a broad basket of the largest 500 stocks within the U.S., is up 19%. That's 19%. Of which NVIDIA makes up about, call it 35% of that return year to date. You take Alphabet, Meta, Amazon, they make up another 30% or so. But that's what we mean when we say narrow. Now, here's what's interesting. If you were to take the S&P 500, right, the top stock in there might be 7% holding, then 6%, then 5%. But if you were to equal weight it, meaning all 500 stocks make up the same percentage, right? Everyone makes up 1/5 of a percent. The S&P is only up 10%, so about half, right? And you can see that right now is obviously a very bullish time for stocks. But on this chart right here, it says on the top right, since 1950, the S&P 500 index has reached 1,434 new all-time highs. Meaning every single time it hits a high, it'll go lower, and then it gets a new high, right? That's a very positive signal, but that's not the area that we focus on, right? We're not looking for the next 3 months. We're looking at a much longer time horizon, called the next 5 to 7 years. So really thinking about the longer term durable themes, these mega trends, if you will. I'll give you a few examples. If we were sitting here 10 years ago, we would be talking about globalization, right? Companies looking at their business models and seeing where they can outsource. Right now, it's the exact opposite. We're seeing a lot of trends on deglobalization, reshoring, onshoring, companies that say, hey, I want to create redundancies in my supply chain, right? I'm going to bring everything in-house because in case there's an external shock, like what happened in Russia, Ukraine, we're shielded from that. Another big megatrend we're seeing is massive acceleration in healthcare, particularly in drug development. Also areas in the energy transition from fossil fuels to renewable sources. And of course, we can't talk about opportunity without talking about artificial intelligence. So, our investment team right now, we hear from them all the time. And one of the parallels they're drawing is right now feels quite similar to the late 1990s. Okay, not in the sense that there's going to be a tech bubble, but in the sense that whenever they hear a company earnings call happening right now today from any company out there, every CEO, every CFO right now is saying, we plan to leverage artificial intelligence to help propel our business into the next decade, right? Just like in the late 1990s, every company was saying, we plan to leverage the internet to help propel us to the next decade, right? That's the similarities. The challenge is how do you decipher investing in the companies that are actually capable of executing artificial intelligence throughout their company versus the ones that are just saying it to appease their board of directors and shareholders? So one thing that we've created at Capital is something called the artificial intelligence stack. And that's what you see in front of you right now. These are the ways and the types of businesses that are needed in order to make artificial intelligence operate. So from bottom up, let's quickly go through it. The first layer is you need the semiconductor chips, right? NVIDIA has been one of the most popular ones. Taiwan Semiconductor, TSMC, controls essentially 80% of the world's chip making. You go one level above that, and that's the infrastructure side. You go one level above that, that's the large language models that are needed to process the information. And then at the very top is the application component, right, the software. Now, what's interesting about this is if you were to ask us which of these levers within the artificial intelligence stack do we find the most compelling right now, we would actually say none, right? And the reason for that is because we're looking at the second and third derivatives of what could come. So here's an example. You can invest in the semiconductors, but we think that might be fairly or overvalued. You can invest in the infrastructure, same thing, fairly overvalued. Where we have the most conviction in is the next wave, which is consumer application, right? What can AI bring to financial services, insurance, auto, healthcare, pharmaceutical, you name it. And in order to drive that, you're going to need AI data centers. And what do you need in AI data centers? You're going to need a lot of factories. You're going to need a lot of regridding. You're going to need massive amounts of precious metals, the ion, lithium, a ridiculous amount of copper to rewire the grid. You're going to need a lot of energy, HVAC systems, a lot of industrials. So those are the areas that we see more appreciation potential from, rather than the already expensive areas that you see right here on the slide. So there is,
in other words, it's a little. In other words, it's a perhaps a little bit late to go all in on some of those the winners, the recent winners.
Yeah, it's a little bit late, and because we have a longer term time horizon, we're trying to see what's around the corner, right? We're not trying to time what the next 3 months will look like and how do we get in. We're really trying to think about these big mega trends. Okay. So one of the misnomers that people typically have when it comes to stock investing is that technology has historically not been a dividend focused sector. But you'll see on this chart right here, in 2003, you'll see a little jump. Okay, so this chart shows you all the different sectors and the amount that they paid in dividends. But you'll see in 2003, there's a little bit of a jump, and that's Microsoft because they paid their first dividend in 2003. You fast forward all the way till now, in May of this year, Meta, formerly Facebook, announced their dividend for the first time. And then shortly after, their stock went up 23%. Just a few weeks later, Alphabet and Salesforce also announced their first dividend. So the point of me sharing this is there is a bit of a regime change, meaning these larger capitalization, these mature tech stocks with very strong balance sheets, strong earnings, somewhat reasonable valuations, they are now considering dividends because they want to signal to the market that they have capital discipline. They want to portray confidence that they have earning stability. So the biggest growth areas for dividend investing that we see, we already talked about it, but it's the billions and billions of dollars going into artificial intelligence infrastructure. It's going to go into the utility and energy companies that we consider to be the silent giants, if you will, of the energy transition. High quality, stable companies with a diversified global stocks that are really trading at a discount. And here's the final point that I'll make is that it's dividend companies that are not just within the US, but when you look at the dividend growth rates globally, the US, we expect it to grow at an 8% growth rate. Europe is about 9%. Japan is 10%. So the main point of all this is if you are currently in a money market fund that is yielding 5%, right? really happy with that. Like Sejal mentioned earlier, they will likely start to cut interest rates. So 2 to 3 years from now, that 5% CD yield might go from 5 to 3%. On the flip side, if you're looking at a dividend-oriented income-producing stock, right now it might have a 2 to 3% dividend yield, but you add on the potential growth rate that I just mentioned, and you're going to be sitting at a much more comparable option. Okay, I'm looking at the clock now. Jeff, do we have time for maybe one more slide, and then turn it back to Sejal?
Yeah, go for it.
Okay, so this is a really important point, and we all here in Southern California, or everyone here tends to have more of a home bias. If you've ever heard the term Magnificent Seven, that's really the industry term for a lot of those big technology stocks like Microsoft, Apple, NVIDIA, Amazon, things of that sort. But what a lot of folks don't realize is if you were to start to look overseas, in Europe, they also have their equivalent. But many people don't know this reference, but they call it the granolas. The granolas, not kind of the bars that you eat, but it's companies like GSK, Roche, AstraZeneca, Novo Nordisk, Nestle, Novartis, L'Oreal, LVMH, which is LV, the designer brand, ASML, SAP, Sanofi. Okay. The point of me telling you this is if you were to look over the last 5 years, and you see on this chart right now, those granola stocks have actually outperformed our Magnificent Seven. And I think that comes at a strong surprise to many folks because they think it's just technology that's growing. But the reality is it does come down to the individual companies, and we don't have any bias to where the borders or where the companies are biased. As long as we find these opportunities, that's what's most important for us. Okay, so Jeff, I'm going to pause again here and see if you have any comments, if the guests on the phone have any questions, and then if not, we'll turn it over to Sejal for the last portion of this, which is around fixed income opportunities.
I think that does, it is a good reminder of, the importance of diversification, right? US certainly is a leading stock market, but it's not the only market out there. We do have a couple of questions coming in more on the fixed income area. Sejal, I think I may, if it's okay, I'll read a couple to you and then feel free to address them when it makes sense. So one is, do you have, does Capital Group have a view more specifically as to what the rate cut will be in September? Is consensus now 25 basis points or more? Another is just really around positioning, like given what's happening with interest rates, what sort of duration would be wise, or what sort of maturities should folks have in their bond portfolio? And maybe I'll say that'll do for now. Thank you.
Yeah, perfect. Well, you guys read my mind. We were going to go there next. So let's jump into that first one, which is Capital Group's views in terms of rate cuts this year. I'll start off by saying that our default is to take the Fed's words at face value. So while many investment professionals here can hold personal opinions, when we think about positioning, we position for the Fed what they've told us, and then we keep a lot of flexibility in our strategies such that if they end up cutting more or less, we can pivot quickly by keeping that liquidity in our funds. So as it stands right now, the last dot plot, which I'll admit is a little stale by this point, revealed that they were expecting to cut just one time by 25 basis points, but that was in the June meeting. So again, we have a lot more information. Based on what we're surmising right now, we anticipate that September will likely be a 25 basis point rate cut. There's no October meeting. We do not think that they will cut in November unless the data really gives us a reason to believe that they will. The reason for that also is that the November meeting happens to be the day after the election. Now, while of course the two entities are supposed to be completely separate, they also want to reduce just unnecessary volatility in the market. So we could see them potentially skipping over November. And then once we get to December, again, based on the data, we think it'll likely be it could possibly, I should say, be another 25 basis point rate cut. There has been speculation in terms of a 50 basis point cut. With all of the new information we have, we still believe that 25 is probably appropriate. Again, if they cut more, that'll be good for fixed income. We can adjust accordingly, but we don't want to expect more and then get less, right? We would rather be a little bit more conservatively positioned and then take advantage if they end up cutting more, rather than position ourselves for something that may be a lower probability event. So again, somewhere between 1 to 2 cuts, we're leaning more in the 25 basis point camp. We do have the capital system here, which is that multiple opinions, multiple managers on each strategy. So we never lever ourselves to one outcome or simply position for one specific scenario. I won't say that there are not members in our investment group that think that 50 is on the table, but when I just sort of take a weighted average consensus view, we're still kind of leaning more toward the 25 basis point cut camp. Now,
And
that being said,
Sejal, one quick reminder, you said when rates go down, that is good for fixed income. So just a reminder, maybe on that, this is basic for some of our attendees, but bond prices tend to move inversely with interest rates, right? So interest rates go down, bond prices go up. So that's really good for folks with an existing bond portfolio. Maybe not as much for those who haven't invested in bonds yet. I don't know if you're able to speak to that a little bit.
Yeah, absolutely. So this is also good because we have the slide listed here. So first off, I'll take a step back and say that when we invest in fixed income, what we earn is what we call total return. And when you rip apart total return, there's actually 2 components. You get your income return or your yield, and you also get your price return or price appreciation or depreciation. Obviously, we saw the depreciation in 2022. Now, the price component is driven by what interest rates do. So if interest rates go up, prices will go down, and we tend to lose money. Well, if interest rates go down, as Jeff mentioned, prices go up, and we make money. And that element will fuel your total return. Now, when we think about the 2 components, one thing I'll mention is over the last 50 years, over 90% of an investor's total return has come from your income and reinvesting that income, right? Your coupon payments. So I just want to emphasize that as much as our statements make us focus on price return, we need to remind ourselves that yield is what really impacts what we earn from fixed income. Now, that being said, in the environment that we're in today, yields are certainly higher than we've seen in quite some time. The chart in front of you illustrates, and this is again as of June 30th, so some of these numbers are a little stale, but the 10-year Treasury yield now is at about 3.8%. Investment grade corporate bonds are giving you close to 5%. Mortgage-backed securities, a little under 5%. Asset-backed at 5.1%. And then high yield gives you about 7.5% today. Right? These are the yield to worst. These are like the conservative yield estimates. So that's the first leg, is take the opportunity to lock in the yields that are being offered today. Now, the second component is duration. How do we take advantage of those price cuts, or excuse me, with those rate cuts so that yields go up, or rate cuts so that price goes up? How do we take advantage of that? We have to have duration. You have to move out on the curve and have some level of interest rate risk in order to take advantage. So the second part of the question is some ideas around positioning. We believe that adding some duration back, getting out of money market funds, CDs, solutions that are really safe and are offering nice yield today. One thing to remember is that when the Fed starts to cut interest rates, those yields are going to come down, and there is no price appreciation there because the NAV does not move around. So what do? We want to encourage all of you to add some duration back to portfolios. How much? Well, in our opinion, if you're really thinking about being a long-term fixed income investor, we think it's appropriate to get back to neutral duration. Neutral is versus the benchmark, which is the Bloomberg Aggregate Index. The Bloomberg Aggregate Index right now has a duration of about 6 years. So what that essentially means is that with a 6-year duration, if they cut interest rates just one time this year by 25 basis points, you multiply 6 times 0.25, that number is 1.5%. You're going to earn 1.5% in price return plus your 5% coupon. Now you're looking at a potential, not a guarantee, a potential of 6.5% total return in just a very middle of the fairway vanilla core bond strategy, right? Then as you add on more credit risk, or maybe you decide to add on more duration or interest rate risk, those yields can potentially go higher from there. And that's what we want investors to recognize is lock in the higher yield today and position yourself with some duration so you can also be at an advantage when interest rates get cut and prices go up. So let me pause there, Jeff. Make sure that there's no follow-up to that particular concept, because that's a really critical one that I want investors to understand in this environment.
Yep. Just checking to see if we've had any more questions come through. No, I think that helps. I think that's, go ahead.
No, I just.
I'm saying, yeah, no additional questions for the moment, okay. Sejal.
Perfect. So then let me just, I know we have about 5 minutes left. So one of the things that I also want to share is that some folks are taxpayers, right? And we're always looking for tax-free, tax-exempt opportunities. So one thing to note is that right now, if you are thinking about a non-qualified account, right? So just a taxable brokerage account, the belief was always that if you were in the highest tax bracket, it made sense to own municipal bonds. And what this chart on the right is telling us is that if you're actually in the 29% federal marginal tax bracket, meaning you're paying 29% or higher in taxes, it makes sense to own some municipal bonds in your portfolio. Of course, if you're sitting here in California, like I know myself, Tim, and Jeff are, it makes even more sense because we pay an exorbitant amount in state taxes. So when you aggregate the two, what we calculated is that the break even is if you're in about roughly the 29% tax bracket or higher, owning municipal bonds could be very additive to portfolios. Now I'll share with you, munis today aren't necessarily cheap, but they're also kind of fair valued, maybe a little rich. But the reason we like it is, one, the credit fundamentals are still very, very strong. If we think about the amount and magnitude of money that was doled out during the pandemic to support state and local issuers, it was a tremendous amount. Even here in California, where we're notorious for not being able to balance our budget, there's still about $12 billion sitting in the reserve bucket. So credit health is very good. Now, this year, state and local issuers are saying, whoa, we don't want to deplete all of the extra money we have. Let's start issuing more bonds to fund the projects that we need to get completed. So accordingly, issuance is up about 30% year over year. So the first question I always ask myself is, wow, if there's that many more bonds being issued, is the demand there, or are munis getting cheaper? And the answer is the demand is there. So the technicals are well supported as well. So not only are municipal bonds an asset class where credit fundamentals are strong, technicals are well supported, and yields overall are higher, so that for those folks that are paying taxes, it does make sense to own this as a sleeve within your portfolio. Let me pause.
And how about, yeah, that's helpful, Sejal. Just as you were covering that, we had some questions come in relative to, what does pricing look like on munis versus corporate bonds, treasuries? So is it still as attractive? Are munis still as attractive?
That's a great question. Yeah, it is. So if I look at the muni to treasury ratios today, right, so we typically calculate the ratio of, let's say, a AAA rated muni bond versus a AAA rated treasury bond, right? So just like if you look at a 10-year muni bond, look at the 10-year treasury. And right now what we're seeing, if I just kind of look, through the month of July, I would say they cheapened across the curve, with the 10-year part of the curve cheapening the most. A AAA rated general obligation bond currently offers about 86% of the yield compared to US Treasury bonds. So that's sort of on the rich end of the spectrum, versus if you look at like a 10-year history, it's on the richer end of things. But it's also, if you look at where it is more attractive, the ratios start to look really attractive on the short end of the curve. So again, it depends on the curve as well. What we're looking at is the front end of the curve, the short kind of 5 years in, looks reasonable. And as you get further out, it gets a little bit more expensive. But that being said, despite that, we still have the conviction because the yields are higher today. So even though you pay a little bit more for it, you're getting compensated with higher yield profiles.
Great. And just a comment I'll toot Tortuga's horn a little bit. Where we've been doing a lot of this over the last couple of years, anticipating that rates would not be high forever. And so, really, we'll maybe go deep on this another day or individually. But I'll just comment that we've been positioning accordingly in order to lock in some of these higher rates, knowing that they wouldn't last forever. And then one more comment or question for you all. Since you do mention taxes, and we're thinking about different sources of income, one thing I like to remember is that, you have potentially different tax treatments on this a little granular, but tax treatment on different types of income. So, in terms of dividends versus fixed income, right? And dividends, stock dividends versus bonds, to be more specific. Do you all have any commentary there, or is it just a topic for a future webinar? Did that make sense, Sejal?
So comparing what one could earn in terms of dividends versus the income that one could collect from fixed income?
Or to be not just the yield, but the fact that dividends are not stock dividends do not receive the same tax treatment that some other income receives. For instance, the income on bonds, right? Income on bonds is treated as, this is not tax advice, but a bit of commentary. Income on bonds is treated as ordinary income versus dividends would potentially receive, capital gains treatment or a tax rate more similar to capital gains.
Yeah, I think it can get very nuanced, but I kind of understand what you're saying. And I mean, frankly, a lot of these bond funds also do have embedded losses coming out from 2022. So those carry forward. And so the capital gains and taxation, at least for the next couple of years, should be significantly less than that of equities. But again, that can get a little nuanced because there's so many different strategies and different, I can't speak kind of broadly.
Sure.
But yeah, the embedded losses in the fixed income strategies are certainly serving as like a tax buffer in this environment.
Good point.
And the only thing, that's from an investment strategy standpoint, right? This is a bit of a Rubik's Cube. Every individual has their own unique tax situation. The dividend stock versus the bond, that's one component, but then also thinking about the type of investment vehicle that can be more tax advantageous. So you might consider a dividend stock ETF to reduce the capital gains, and then complement that with a municipal bond portfolio, so you get multiple tax advantages, right? That's just the different parts of the Rubik's Cube.
Sure. Yeah, it obviously gets complicated and very dependent on the individual situation. Okay, let's see if we have any more questions. Let me just do a quick time check. No more questions at the moment. And I'm all in favor of being relatively concise, so we can potentially wrap a little bit early if neither of you have any closing remarks. Any final thoughts?
Yeah, I'll share one final thought, which is just,
Sure.
if it hasn't come to conversation, which perhaps it hasn't because we got pretty technical, the big takeaway from Capital Group and all of our, home of the American funds is that we are really excited about the opportunity in fixed income right now, both again from a yield standpoint, from a potential price return standpoint. Total return looks really attractive potentially over the next several years. And so we want to encourage folks to really consider having an allocation to this asset class. I know the rear view mirror has looked very painful and a little ugly at times, but again, looking through the dashboard, the opportunity in our opinion is now. Don't wait until the Fed cuts, because the markets tend to price things in before they even happen. 25 basis points for a September rate cut is already priced in. But that's where we have to go back and think about the remarks from that former Governor Evans, who told our portfolio manager, hey, listen, they're not just going to stop with one cut. There's going to be more thereafter. So let's take care of getting positioned so that we can take advantage of what comes after September as well. So lots of opportunity. We are here to help. I'll turn it over to Tim to see if he has any other closing remarks. But thank you all for having me on this call. It's been a real opportunity and treat to share some of our enthusiasm with all of you. And thank you so much, Jeff. Back to you, Tim.
Thank you.
Yeah, thanks. I would complement that and say, just like she talked about in the fixed income side, both on the equity and just general market outlook, we are extremely enthused for the opportunity to come. Now, the asterisk here is someone at the very onset said in the polling question, what's the topic of interest? People asked for interest rate. Another person asked for the election. There will be some volatility, right? I don't want to say everything's going to be rosy. We see this every 4 years, like clockwork. Around the May to September timeframe, in the election year, there's about 3 to 4 times the amount of money market inflows, meaning folks are calling their financial advisor, Jeff, saying, hey, Jeff, something in my gut's not sitting well. I'm a little bit nervous. I'm seeing all these headlines. That is normal. Again, that happens every 4 years. And statistically speaking, the empirical evidence always comes out saying, if you had stayed invested, not taking your money out and held your money for the long term, you're going to be perfectly fine. So that's my parting message to you is there may be something that happens in the next 6 months to a year that you're not going to be happy with, but you just got to stick with it. And I get the opportunity to work closely with Jeff, with Angela, with Kevin, with everyone at Tortuga Wealth, with Rachel. And I can't emphasize this enough. I get to see firsthand how hard they work on each of your behalf. So just make sure if you have questions, give them a call, because they're going to be the best thing that you can do. Thank you.
Thank you so much. Well, yes, definitely a privilege to have you both, Tim and Sejal. Thank you for all your insights. One comment and reminder I'll make is that Tortuga for those that didn't catch them, Tortuga has done a series of webinars this summer, in particular this summer on the subject of on some other subjects. So not just on the markets, but also on other aspects of financial planning, particularly in estate planning and business succession. Those are up on our website. This will eventually make its way to our website as well. And feel free, if you have feedback or ideas for future webinars, feel free to send them our way. And with that, I think I'll close. So thank you very much and look forward to hearing from you soon.
Thanks, everyone. Bye.